China might just be the comeback king of 2024. At a time when the Indian and American stock markets are hitting fresh new highs, the China Golden Dragon Index, or CSI, is hitting 5-year lows. This kind of divergence has never happened in modern stock market history, which leads us to ask an important question as to whether or not China is a deep value opportunity or simply a trap for wary investors. And I don't know about you folks, but at least for me, the answer is pretty clear. Based on the data that I'm seeing out there, as well as the policy support and action from the government, the Chinese market is potentially on track to recover sooner than many people think. What exactly leads me to believe that, and what are the challenges of making this kind of bold bet at a time when fear for US investors is at an all-time high? Well, folks, those questions are exactly what I want to address in this video. And well, what better way to start, folks, than by first addressing the elephant in the room, which is Alibaba. Alibaba just reported its full-year earnings for 2023, and the results, at least for me, are quite shocking. In its Q3 2024 earnings report, the company announced revenue growth of 5% year over year, which was in line with most analyst estimates here in the West. The earnings comprise of cloud revenue that grew by 2.6%, 2% above analyst estimates, as well as EBITDA, which grew a whopping 1.5% at a time when the company's competitors and the general Chinese economy is actually contracting. And what's even better is the fact that their digital commerce group revenue for the year, which is essentially their international business through AliExpress, grew by a record 44% year over year. And it's not just revenue. The company reported really good performance across the board for local service margin, the Kaino Logistics Group, as well as the cloud business, which we all know is the main segment that most Western investors care about, as it has the only opportunity to be spun off and potentially save the company at a time when growth and competition is increasing. And China Commerce, which is largely dependent on mainland competitors like Pingdongdo as well as JD.com, contracted only by around 2 basis points. Yes, those segments with the highest growth rates are also some of the smallest percentage of total revenue for that quarter. But as we all know, investors are always forward-looking, and the outlook here looks completely different than what is being painted on Wall Street right now. An over $35 billion share buyback and repurchase program has also just been announced by the company at a time when insiders like Jack Ma and Tsai have been loading up shares at a PE ratio value of just $10. And by far what makes this report extremely interesting is the idea that this was announced just days after the government of China stepped in to say that it would help support the economy as well as investors through not only banning certain kinds of short selling, but also buying back stock through state-owned funds. And this, in my opinion, is an important inflection point that acts as a good learning lesson for anybody who wants to invest in stocks, which is the idea that historically, whenever the government makes a drastic switch in its tone and sentiment and takes real action, like the appointment of a new chairman of securities, markets tend to react favorably. Because you see, folks, investing is a game of psychology more than it is a game of mathematics. The CSI Chinese index has drastically underperformed the S&P 500, which leads many people to believe that the S&P 500 is a safer and much better bet than anything in China. This paired with the fact that most people in the West don't understand the mainland economy in China and basically read and comprehend whatever they see on social media and any headlines they see on the Wall Street Journal has led to this kind of compounding effect around the sentiment for these businesses. And because of that, it is absolutely no surprise that these valuations have come down to the levels that they have, despite the fundamental solidity of the companies. But obviously, just like anything in the markets, no phase lasts forever, and there is always an inflection point. Similar to the way markets reacted during the pandemic here in the United States, when the government stepped in to fund investors' bank accounts as well as mortgage-backed securities, China is planning to do the exact same. It's been very well known that in China, policy leads to investment, whereas in the US, investment leads to policy. And that is exactly the signals we're starting to get right now with what the Xi Jinping government has said, as well as the watchdog and different regulatory shuffles we're starting to see. Yeah, this doesn't mean that things are going to get better immediately, or there's no guarantee that certain businesses are going to outperform others. This is simply, in my opinion, a really good case study to pay attention to in case things evolve differently than we expect in 2024.